Samiran Chakraborty is joining me here in our studios right now, Chief Economist with Standard Chartered. Samiran, good morning. Great to see you here. Can we safely say that is the case and RBI in all likelihood will cut now in June?
Well, if you purely look at the inflation trajectory, it does appear that a rate cut in June is quite possible. The last couple of months, inflation print has been lower than expected. That should give RBI some comfort. But I think a couple of other things also will have to be taken into account. One is if you look at the preconditions that RBI suggested in its April policy, one of them was clearly about the pace of reforms. And it appears that with both the GST and the land acquisition bill going to the select committees now, the pace of reforms have got halted momentarily. That should remain a concern for RBI. And the second concern is that probably globally reflation trade is going on where people are getting a little bit uncomfortable about commodity prices moving up again. So maybe the RBI might want to kind of see through this phase of commodity price up move before deciding on the next rate cut. But still on balance, we would think that the chances of a rate cut in the June policy is still there.
What about the other two things, which is the fact that from April monetary review, the rupee is down 3%, oil is up 10%.
Yes, clearly that's the kind of reflation trade I was talking of, that you have commodity prices going up, you have exchange rate depreciating, so overall it could have an impact on inflation going forward. But as we know that the CPI is much less sensitive to both these things, oil as well as an exchange rate compared to say something like WPI. So I would worry less on these two factors. I would worry more on the food prices, and two important things coming up. One is the effect on monsoon, and the other is the MSP increase, which can happen in June. So to what extent these two things drive the food price dynamics in the near term would be very, very critical. We have an extremely benign base on food prices going all the way up to August. So if in this period food prices don't increase substantially, you could see inflation numbers staying in the 4 handle for almost 4-5 months, giving RBI some scope for rate cuts.
Do you think so one argument which is given is that, well, it better be June because then otherwise you get closer to a potential rate liftoff in the US with the Fed. Is that a criterion which is important to consider?
Well, in our view, the Fed rate hike has relatively lesser impact on India's macros. So from that perspective, I would say that as soon as RBI gets more comfortable with the inflation trajectory, they are likely to cut. So that's why I would suggest that the rate cut comes earlier rather than later. And also, let's face this, that if the rate cut comes with very long gaps, then the monetary policy transmission to lower lending rates, etc., also becomes extremely uncertain because the bankers also have no certainty over when that next rate cut is going to come. So it's always better to have a kind of for front-loaded rate cuts where you at least see part of that getting transferred into lower lending rates.
So if the, by the way, when is the second forecast from the Met Department, Samiran?
That's probably going to be in July, so it's some time after the policy, so it's not going to be immediately around the policy time.
It's not something that the RBI won't have that
Yes, it
data.
will not have that information to start with.
But so it's not as if even if the RBI didn't want to cut for whatever reason, its own assessment, it's not as if it will cut because of considerations that maybe potentially there'll be a Fed hike in the US. You don't think it's not a factor which will swing the pendulum one way or the other, right?
It doesn't look like. In fact, I would argue that with most of the central banks actually cutting rates, we've seen China cutting rates, we've seen Australia cutting rates. Maybe this is the time to cut rates. From a global perspective, we've seen the first quarter, 25 central banks had cut interest rates. So we are in a phase where interest rate cutting will not be taken negatively by global investors.
Sure. Fair enough. Now let's come to the IIP numbers which were released as well. Now that A pretty dismal picture. I guess not really a surprise because month on month numbers tend to be very volatile. But what's your own reading there?
Well, to be honest, the indicators that we got about IIP from minus 21% export growth, infrastructure industries growth at just about 1.4%, we were predicting an even worse number.
Okay.
So from that perspective, this is a slightly better number. What is comforting is that the capital goods component for almost 5 months now is registering something in the range of 6 to 8% growth and not showing too much volatility. So that is a comforting fact. And the other comforting fact is that consumer durables degrowth, which was significant over the last fiscal year's last few months, that degrowth is coming down. We are still to see a substantial uptick in consumer demand. The negative is that the revival in consumer non-durables we had seen last month seems to be completely gone this month. So our overall take is that this is talking about the economic cycle not yet picking up, and maybe another 6 to 12 months for it to pick up on a sustainable basis. And it has to be driven by the investment side of the economy rather than the consumption side.
Are there, by the way, is there any sense that that is happening? I mean, any indicators that you follow that suggest that is happening?
Well, if you just break down the investment part also, our sense is that the private investment is suffering from 3 headwinds: high level of corporate leverage, low level of capacity utilization, and high level of banking system NPA. So the first kick to the system has to come from the public investment side. Yes, there has been a substantial increase in the budgeted allocation, both at the central level and most likely at the state level as well. But unless this money is released and it kind of walks through the system, you'd probably not see the full impact of that coming on to the actual real activity numbers. So we probably have to wait about 6 or so months to see the first signs of the investment activity numbers picking up. The good news is that the stalled projects have come down substantially. Whether these projects are actually generating any output or not, I'm not very sure.
Out of the 3 things that you mentioned which are hampering private capex, what stands out is low level of capacity utilization. You know, we speak with public sector banks and they will very flatly say that there is no real demand for credit. It's not as if there is, you know, people are queuing up to take out loans. It's not happening. That suggests, I mean, no demand in the system, right?
Yes, as in this is one of the challenges. It's a little bit of a chicken and egg problem that unless you have investment and that generates higher wages, that generates higher demand, and the higher demand leads to higher investments. So this cycle, when it's depressed, the only way to kickstart the cycle is actually through public investment, which generates that demand to start the cycle. And that's why I was stressing on the fact that this money needs to be spent as quickly as possible, both from the central as well as from the state budgets.
Fair enough. We'll leave it there, Samiran. Quick conversation today. Thank you very much for your time. Appreciate you dropping by for that. Thank you.